When it comes to investing, you can either let someone else do it for you or you can do it yourself. If you're very knowledgeable about investing or really enjoy learning about it, then you might enjoy investing on your own. But if you're like most, you might find picking your investment to be difficult, and you might decide to hire someone else to do it for you. One option for having someone else manage your money is called mutual funds. It's the most common choice made by many people investing on their own. However, using a mutual fund is not the same thing as hiring a stockbroker or a personal financial advisor. I'm talking about having a manager of mutual fund invest for you. A mutual fund is a basket of stocks picked by a professional money manager on behalf of outside investors who put money into mutual fund. Mutual funds charge fees based on the amount of money you invest in them. If you invest in a traditional mutual fund, also called as open-ended fund, you can select a specific mutual fund and then spend your money to them. Then the mutual fund will pool that money of yours with the money from thousands of other investors and invest it in a group of stocks that they think are attractive investment options. If these stocks go up, the investors earn positive returns, and then the investors can sell the mutual fund for more money than they bought it for, and those returns are distributed to the investors. The manager of the mutual fund is an investment professional whose job is to pick a basket of stocks that will increase in value over time, but with a reasonable level of risk. Note, and this is very important, there are no guarantees that a mutual fund will make money for you. The investment manager will do their best to pick a basket of stocks that will rise in value. But in some years, more stocks go down, which means your investment is likely to lose money, like in 2008 for instance. Also, if you're investing with a tax-deferred plan like 401k, then the chances are high that your employer has already picked a mutual funds you can use. A typical 401k will have a menu of perhaps 6 to 10 mutual funds that a person can choose from. You should try to pick no more than 2 or 3 of these 10 in most cases. To pick 2 or 3 of these funds, you should start by looking for mutual funds that fit your investment objectives. All mutual funds list their investment objectives upfront. For many, that investment objective involves trying to beat some sort of benchmark. A typical mutual fund will often say that they want to beat some sort of stock index like S&P 500 or NASDAQ, or alternatively, some funds will be focused on beating certain bond indexes, like they say treasury bonds or corporate bond indexes. Group of stocks like the S&P 500, the NASDAQ, and others are just pools of stocks that tell an investor how well their investment are doing compared to the overall market. You can compare yourself against any of these pools, often called as benchmarks, to get a sense of your own individual performance. As an investor, you should choose a couple of mutual funds that reflect the level of risk and return you want to achieve.